Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And today we're diving into Micropolis Holding Company's latest attempt to raise some serious cash. Get ready because this filing reads more like a roller coaster manual than a business plan. And trust me, there are more risks than a tightrope walker at a circus. Oh, and before we dive deep, if you love getting straightforward insights into these massive filings, make sure you hit that subscribe button and join our growing community. We've also got a fantastic Discord server linked in the description below where we break down these documents even further. Micropolis Holding Company is looking to sell off a boatload of shares, up to 7.1 million to be exact. But here is the catch. They are not selling these shares themselves. The money is going to a shareholder named Streeterville Capital LLC. This whole deal is basically Streeterville Capital trying to cash out on some notes and warrants they got from Micropolis. It means Micropolis itself probably won't see much direct cash from this sale, except maybe if Streeterville decides to pay cash for some warrants instead of just handing them back, which is unlikely. They are saying they might get up to $25 million from that warrant exercise, but it is a big if. Let's actually find out what these numbers look like with our own eyes. So we'll scroll to the financial statements. So we are looking at their balance sheet on the 30th of June 2025. The company had total assets worth about $6.9 million. But here is where it gets interesting. Their total deficit and liabilities were also nearly $6.9 million. This means they are basically wiped out on paper at that moment now. Looking at the end of 2024, their assets were around $9.8 million, but their liabilities and deficit were a whopping $40.6 million. Yikes! That is a huge negative equity. This shows a severe financial strain. Now, let's see how they performed during the year. So we'll scroll to the statement of comprehensive loss. This is where things get a bit scary. For the period ending the 30th of June 2025, they lost over $3.2 million. If we look at the entire year of 2024, the loss balloons to over $22 million. And in 2023, it was close to $12 million. This company is bleeding money, and it is not a small amount. So when they are saying they are pre-revenue, they really mean it. Their revenue figures are tiny dribbles compared to their enormous expenses. It looks like they are burning through cash extremely fast. Let's see where all this money is going, so we'll scroll to the operating expenses. Administrative expenses are a huge chunk of their spending. For the year 2024, they spent nearly $18.5 million. This is a massive increase from the previous year, and a lot of it is due to the IPO process and manpower costs. They are also spending a lot on marketing, which jumped from just about $14,000 in 2023 to over $750,000 in 2024. They seem to be trying to get their name out there. But are they getting enough sales to justify it? The story here is that Micropolis builds robots, but they are not making much money from them yet. Most of their projects are collaborative, meaning they are working with others to develop technology. They are heavily reliant on partnerships, especially with government entities like the Dubai Police. This is a double-edged sword. It gives them credibility and access, but it also means their success is tied to these specific collaborations and their future funding. The company is focused on the UAE and Saudi Arabia markets, which are growing, but they face challenges like talent acquisition, regulatory uncertainty, and the need for market adoption. Their competitive strengths include in-house research and development, innovation, and strong government partnerships. However, they also admit to risks like software malfunctions, unproven market demand, and the difficulty of recruiting and retaining talent. Let's scroll down to the risk factors to see what keeps them up at night. These guys are not mincing words about the risks. They openly state that a significant number of shares are being registered for resale, which could depress their share price and increase volatility. They also highlight that they may continue to incur losses in the future and that their future growth depends on maintaining sufficient funding. They are also really worried about not owning 100% of the intellectual property they develop in partner projects. This could limit their ability to make money from their innovations. And then there is the threat of cybersecurity risks, which is a big deal for any tech company, especially one dealing with robots and potentially sensitive data. Given their financial situation, we should also check out their debt. Let's scroll to the indebtedness section. As of the 31st of December 2024, amounts due to related parties were over $5.9 million. A big chunk of this is from a loan by Egor Romaniuk, who is a majority shareholder. This loan carried a hefty 20% interest rate, which is quite high, even though they paid back a lot of these loans from the IPO money. The sheer amount of related party debt shows how much they've relied on internal funding. Now let's talk about their leadership. We'll scroll to the management section. The leadership team has a mix of experience. Fareed Al-Jawari, the CEO, is a founder with a background in product design and digital transformation, which is great. The CFO, Dimitri Castahoral, has international finance experience. Marwan Al-Sakal, the chairman, has a strong background in investment and development. However, we see that many of these individuals have extensive service on other boards and companies, which can raise questions about their ability to dedicate sufficient time to Micropolis. Now for the big question, are they actually making any money? Let's scroll to the revenue section in the financial statements. For the year ended the 31st of December 2024, their revenue was a measly $35,415. Yes, you heard that right, and for the year before, it was around $577,000. But that was mostly from one project with a Saudi company. They are still pre-revenue basically. They expect to start making substantial revenue by the second quarter of 2026. Which is still a long way off. This means they will continue to burn cash for a while. Honestly, looking at these numbers, Micropolis Holding Company is in a very precarious position. On paper, their equity is deeply negative. They are losing tens of millions of dollars a year and their revenue is minimal. Their reliance on a few key partners, especially government entities, is a significant risk. While they have innovative technology and a vision for the future of robotics, they are very much a startup facing immense financial hurdles. Investors should be extremely cautious. This offering seems more about enabling an existing shareholder to exit than a sign of robust growth. That is our deep dive into Micropolis Holding Company's latest SEC filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into these corporate documents. Don't forget to check out the Discord in the description for more real-time discussions and insights. Thanks for watching. See you next time on Corporate Decoder.